Hello, I'm Simon Lambert of This Is Money. For share-picking investors, 2025 looks like an interesting prospect. Markets are riding high, but with most of the attention still on the US Magnificent Seven, there's plenty of opportunities to profit elsewhere. To help investors, Hargreaves Lansdown has compiled its 5 shares for 2025. I'm joined by Matt Britzman to find out more. Matt, one of the stocks on the list is one of the Magnificent Seven, and perhaps the most high profile of the Magnificent Seven at the moment, Nvidia. You think it can still profit from here, even though it's made huge gains in 2024? Tell us a bit more.
Yeah, I think so. I mean, you're right to frame it that way, because that's the question that investors should rightly be asking. When you look at a stock like Nvidia that's had such a good run, such a mammoth growth story, arguably the bellwether of the AI transition that we're seeing, what's to come? Is there more to come? And can it continue to deliver? Now, we think the answer is yes to a lot of that. Part of the reason I think it's interesting to just go back first and think, where does Nvidia come from? Why is it here? And how has it had that growth story to think about what the future holds? So I think if we look back at the AI transition and accelerated computing power, they kind of call it now, and it's Nvidia's chips that are the kind of the foundation of allowing that to happen. What Nvidia's been able to do is, its addressable market used to be a pie like this. As the AI transition came through and it used its chips, it's managed to grow that addressable market. And that's kind of the one thing that companies try to do over and over again. It's very difficult to do. Some companies can, some companies can't. Nvidia's managed to do that. What we think now is that addressable market still has further to grow. We think that there's an opportunity that markets still underestimate how far it's going to grow. Again, this is a completely new technology and a new way of doing computing. So it's not always a case that what we think is the market now is going to be the market in 2 years, 5 years. So we think there's further to grow. Just to put some numbers on this, Nvidia itself thinks there's about $1 trillion worth of infrastructure. I think it's upgrading to new accelerated computing. We think that there could be an additional 1 trillion or more in new infrastructure that's needed to drive new AI products. So if you think about ChatGPTs of the world and the kind of products that we're going to see in the next couple of years, those all need, or a lot of them are going to need, the raw power of these Nvidia chips in order to process and to have these products come to fruition. We see that as a continuing growth driver into 2025 and beyond. Now, I think one of the ways you can look at this is, a lot of that we mentioned the Magnificent Seven, is the other Magnificent Seven companies that are some of Nvidia's largest customers. So you think your Amazons, your Metas, your Teslas for autonomous driving. We see those companies continuing to invest over 2025. Perhaps not at the same growth level that we've seen for the last couple of years, but still at a high enough level to drive significant earnings growth for Nvidia, all things being well. So I think for us it's that idea that, yes, there's been some mammoth growth in the past. We think the addressable market still has further to go, and we think that Nvidia is going to stay a major player in delivering those chips for the AI transition.
And whilst we've got other chip makers and other chip designers looking enviously on and bringing out their own chips for AI, Nvidia is still the market leader.
That's correct. So new chips aren't a new thing. So Amazon's been making their own chips for a while. Meta's been trying to do the same thing. Apple's been trying to do the same thing. Throughout that, though, Nvidia as the kind of juggernaut has continued to take market share and to retain its dominance. We think it's got a good chance to do that in the future. Will its market share probably come down? I think yes. But if the market grows big enough, then it doesn't really matter if it gives up a few percentage points here and there to some more specialist providers coming in. But I think one of the other things that people don't quite, give Nvidia full credit for is the hardware is one side of things, but Nvidia has a really strong software layer that goes on top of that, and that allows companies to really harness the raw power of these graphics processors, GPUs that they call them, the chips. And that's one of the things that keeps companies locked in, because once you're into that system and you've got a load of Nvidia hardware on one side, it's quite difficult to move outside of that. And one of the other things I think is quite important is the innovation cycle from Nvidia is, arguably unlike anything we've seen. Each year they've got a roadmap to generate a new next generation chip. So they're constantly improving, compounding that benefit that or that kind of market strength that they've got, and that makes it really difficult for anyone to come in and meaningfully displace them. Like I said, on the edges and with some specialist areas, probably will be some displacement, but we think that core kind of raw computing power that people are going to need over the next 5 to 10 years a lot of that's still going to come from Nvidia.
And now onto a stock that is closer to home, in fact, very close to home for the UK investor, the London Stock Exchange Group. Now, this is a share that I guess many people might not fully appreciate exactly what the company does nowadays. Yeah. Tell us a bit more about that and why you picked it.
Yeah, completely agree with what you said there. I think when you think of London Stock Exchange Group, you think of a stock market, you think of maybe the FTSE 100, the FTSE 250, etc. Those are actually quite a small part of London Stock Exchange Group's current business. Over the last few years, it's been expanding through mergers and acquisitions of peers into the data and analytics world, which is now its major revenue driver. These are the kind of systems that analysts like myself, my team around us, fund managers, traders will use on a day-to-day basis to help look at the stock markets, look at companies. And we think for us, that's a very sticky business model. Because once you have a data provider, unless something's major going wrong, you don't normally change. So for starters, I think it's a very sticky business model there. The second thing I think is that when you have large amounts of data, and we just mentioned kind of AI with Nvidia, the best thing that you can do with AI is to train it and use it with data that you've got. Now with a lot of data, LSEG, or London Stock Exchange Group, has a really good opportunity to leverage AI and use it into that data to produce new products and services for analysts and fund managers, etc. So we see that as one key kind of growth driver. They've also been quite smart, and they've partnered with Microsoft recently, and looking to introduce and kind of integrate their data analytics into Microsoft tools. So people that use an Excel or Word or Teams will have access to those data analytics tools as well. So we think that's another growth driver potentially in the future. One of the other things I think that we've seen with London Stock Exchange Group is, in terms of their investment cycle, they've put some money to work already. What we now think is that money is now going to yield the results over the next probably 1, 2, 3, 5 years, all being well. And one of the things that we've seen with the market in that data analytics side of things, the US peers have had better returns. They trade on higher multiples. But we think that gap can shrink over the next few years as London Stock Exchange Group starts to yield some of the results from its investment that it's been doing over the last few years. So that's the kind of trajectory we think it's going to be going on. We think it can kind of narrow that valuation gap with some of those higher valued US peers.
We've talked about two shares that arguably are growth opportunities there. Now one that seems to be a bit more of a value play. GSK, GlaxoSmithKline.
Yeah.
What's the idea behind this pick?
Yeah, so I think, think about the UK market, you've got some of those really fantastic legacy business areas, whether it's financials, whether it's miners, and pharmaceuticals I think would fit within that. GSK is one of those kind of bellwether pharma companies for UK markets, has been for a long time. One of the things I think we've seen over GSK over the last year or so is a bit of a pullback in the valuation for a couple of reasons. Firstly, some unsuccessful vaccine rollouts in the US, which has weighed on sentiment over the last year. But more importantly, there's been a big litigation case in the US with respect to a heartburn drug that they bought out. And that's really kind of hurt sentiment over the last year. More recently, we've seen some progress on that. They settled for around $2.2 billion, which sounds like a massive number, about 93% of the cases a few months ago. But that was actually much better than markets had feared at the time. Now, what we're seeing in the valuation is you don't perhaps think that the valuation's recovered as much as it should have done now that some of those headwinds have abated. So for us, it seems like a very good opportunity to get a quality pharma company with a decent dividend yield as well. So for income investors, it's offering something as well at a valuation that looks attractive to us over the medium to long term. So I think it kind of hits a few different points there in terms of what we're looking at and what we're thinking about in the future.
Matt, thank you very much.
Thank you.
And thank you very much for watching. Good luck with your share picking in 2025. Goodbye.